Hi there, I'm Irk, and this is my channel, Get Irk. Now that stocks have started to pull back, many analysts are wondering whether or not this is the start of something new or if the bull rally can continue after this natural pullback. Let's take a look at the bull and bear case for next week, as well as the moves that I made in my own portfolios this week. The bull case for stocks next week is that we're headed into the end of the month and the end of the first quarter, and many firms, when they release their reports each quarter, have to make it look like they owned the most popular stocks going into that quarter's end. As a result, these firms will buy the big stocks, whether it's Nvidia, Apple, Tesla, Microsoft, or anything like that next week. It's called window dressing, and a lot of bulls believe that will cause stocks to go higher as we go into next week. Additionally, we're in a seasonal time of the year that actually favors bull rallies. So a lot of bulls believe that the pullback that we saw this last week was just a natural correction, and that the market is just building up strength before it heads into a new bull rally. The bear case for stocks next week is that Fed Reserve Chairman Jerome Powell testified in front of Congress last week, and he gave extraordinarily hawkish commentary, suggesting that the Fed is going to do a minimum of 2 more rate hikes and will keep them higher for much longer than many expect. Additionally, an analyst firm released a report that said that 2023 was the inverse of 2022. In 2022, the sell-off ended mid-June, and stocks rallied pretty spectacularly from mid-June until the end of August when the Jackson Hole Fed meeting was. If 2023 is the inverse of 2022, that means the peak that we saw last week marks the high for this bull rally, and that we should see it sell off pretty significantly from now until August. Additionally, bearish technicians point out exactly how overbought the market is right now, particularly the NASDAQ. And since some of the biggest movers in the NASDAQ are also the biggest movers in the S&P 500, this could be a sign for a big sell-off in the weeks to come. Bitcoin rallied hard this week on the back of the launch of the new EXD exchange, which is a joint venture between Fidelity, Schwab, and others in the space. With traditional finance firms entering in the crypto space, this is bullish for Bitcoin. As you can see, Bitcoin really rallied off of its lows. It did find a little bit of resistance here in one of the trend lines that we've been using in previous week's videos, but then it shot right through when it built up support. It ended up shooting through this point of support from this bullish parallel channel that I had drawn in the past, and you can see that it actually found support here. It touched back and then headed even higher, which is a bullish sign for Bitcoin. A lot of bulls believe that the last chance to buy Bitcoin before the institutions start pouring money into the space is now, and this could be potentially more bullish for Bitcoin going forward. Of course, when you've seen a 27% rally in just a matter of days, it's also possible that Bitcoin could pull back. A natural correction would be appropriate at this point, so many bears are predicting a pullback from here as well. If you use Fibonacci retracement, you can see that the 50% line, which would be a half pullback of the move, puts us at $28,086 as a good buying opportunity from here. Bitcoin rallied through $31,000 this week, and wherever Bitcoin goes, Coinbase follows. As a result, Coinbase was the biggest winner in my investments in play portfolio, gaining 10.71%. For me, Coinbase is part of a speculative basket. I don't really have a full allocation in this position because it's hard to tell whether or not Coinbase will be the winner going into the future, regardless of what happens in Bitcoin. However, this week's rally did make Coinbase pop, and it was the week's winner as a result. Investors can't stop dumping the garbage stock that is Canopy Growth Corporation. Between cooking the books and the problems with the cannabis sector, Canopy just continues to lose value week after week. Canopy Growth lost another 17.84% this week, and I honestly don't have any reason to believe Canopy will survive. The only reason I haven't cut my losses in this stock is because there is the possibility it could recover. Additionally, I've locked in the maximum amount I'm willing to lose, so I'd rather ride this one to zero than miss out on a possible recovery, especially since I'm already down so far in this awful stock. Natural gas made a comeback this week, with UNG, the U.S. Natural Gas Fund, gaining 4.87% and being the winner of my speculation in play portfolio. U.S. natural gas is trading at about $2.50, whereas internationally it's trading as high as $13. Thanks to a number of liquid natural gas transfer stations that are in construction right now, it's possible the United States could start exporting LNG to the rest of the world. And if this happens, U.S. natural gas's price price will go to meet the price of the rest of the globe. This is incredibly bullish for natural gas, particularly since we're reaching summer season where electricity needs to be produced for air conditioning and a lot of Europe is still using natural gas. Even though gold firmed up toward the end of the week, it still impacted all of the gold miners, particularly the junior gold miners, and one specifically, Gold Minerals, which is the biggest loser in my portfolio this week, dropping 18.5%. Investors are fleeing this one as they believe there's no way Gold Minerals is going to be able to meet the requirements to not get delisted. Additionally, the 1-for-25 reverse split just ended up destroying value in this stock, and there's no reason to believe it won't go to zero, even though it's currently at $1.95. I decided it was time to take some profits in Lyft this week. While I do believe that the oligopoly between Lyft and Uber will continue into the future, and I think Lyft makes a good speculative investment, when it had the disappointing analyst call last week, it was time to start limiting my allocation. I sold at $10.15, which locked in 4.1% in gains on shares I bought for $9.75 when I originally opened this position, which reduced my per share cost 8% down to $8.05. From here, my next buy target is $7.90, slightly above Lyft's all-time low, which it saw a month ago, and my next sell target is $16.10, quite a bit under Lyft's high that it saw earlier in 2023, but I want to be a little bit more conservative with this one as I feel like it's incredibly volatile. I added more to my position in the Sprott Physical Gold Trust this week when gold rolled over and started to sell off. A lot of people ask me why I buy both gold and Bitcoin, and it's because they have similar theses, but they're actually inversely correlated. When gold does well, Bitcoin tends not to, and when Bitcoin does well, gold tends not to. However, both of them are alternative assets with no counterparty risk, which is why I have exposure to both of them. Sprott's Trust beats any of the ETFs that track gold because it is physical. It is buying gold one-to-one, whereas GLD and IIU may not be doing that. I added at $14.75, which lowered my per share cost 1.64% down to $15. From here, my next buy target is $13.95 above a past point of support, and my next sell target is now $16.05, slightly under the high the Physical Gold Trust saw earlier in 2023. To learn more about long-term investing, check out my website, getirk.com, which is always 100% free. Please hit like and subscribe, and if you didn't like the video, leave me a comment. Let me know where I can improve. Thanks for watching, and I'll see you in the next video.